In the final week of March 2021, tens of billions of dollars of stock were dumped onto the market in a matter of hours. The seller was a firm most of Wall Street had never heard of, and on paper, it owned none of the shares it was liquidating. The firm was Archegos Capital Management. In under a year, its capital had swollen from about $1.5 billion to roughly $36 billion. By the government's account, it controlled more than $160 billion of market exposure, without filing a single public disclosure. Strip away the jargon, and this was the oldest failure in the book: concentrated, leveraged, illiquid bets, all pointing the same direction. What made it modern and invisible was the instrument. Lead with the swap. The swap is the whole story. Archegos managed only the wealth of one man, Bill Hwang. That made it a family office, exempt from registering as an investment advisor, and exempt from the ownership filings every large fund must make. It answered to no one but its founder. Hwang did not buy stock. He bought total return swaps. Under a swap, the bank purchases and holds the actual shares. Archegos simply collects the gains or pays the losses, posting a slice of the value as margin and paying the bank a financing rate of roughly the benchmark plus 0.5%. The first consequence: disclosure vanished. Ownership rules attached to whoever holds the shares, and on paper, that was the bank, not Archegos. A fund with a controlling economic interest in some of America's most watched stocks filed absolutely nothing. The second consequence: the leverage cap disappeared. A normal margin account lets you borrow about $1 for every dollar of your own. Swaps are private derivatives. That limit does not apply. Margin was negotiated bank by bank, and that is the door the leverage walked through. The third consequence was the deadliest. Hwang ran the same trades across roughly 8 or 9 prime brokers at once: Credit Suisse, Nomura, Morgan Stanley, Goldman Sachs, UBS, and others. Each bank priced its risk against the slice it could see. None of them could see the whole. And the book was brutally concentrated. Archegos held enormous economic positions in a short list of illiquid names: ViacomCBS, Discovery, Baidu, Tencent Music, VipShop, Farfetch, IQIYI, and the Chinese education company GSX. By many accounts, it was the single largest economic holder of ViacomCBS in the world, and no exchange, no regulator, no rival bank knew it existed at that size. Here is the fuse. Credit Suisse held only about 10% margin against its Archegos book, and it set that margin as a fixed dollar figure at the moment each trade was struck. So as the stocks rose, the margin shrank as a share of the position, and the leverage climbed silently 10 times, then higher, with no call to flag it. Credit Suisse's own engineers had proposed a fix that adjusted the margin dynamically as positions moved. It would have cost about $150,000. It was never approved. In the year before the collapse, the bank earned roughly $17.5 million in fees from Archegos, against an exposure that would cost it billions. The keystone was ViacomCBS. Hwang's own buying had helped triple the stock into March. Then management chose to cash in on the strength, announcing a $3 billion capital raise, 20 million shares at $85, plus $1 billion of convertible preferred. The offering priced below the market and landed on a stock whose float was dominated by one invisible, maxed-out holder with no capacity to defend it. ViacomCBS fell about 9% on March 23rd, about 23% on the 24th, and about 27% on the 26th. In a single week, it went from roughly $100 to about $48. Watch the collateral at Credit Suisse. 2 days before the end, Archegos held more than $600 million of excess margin. On March 24th, that cushion was gone, and the account swung to a deficit. By the 25th, the deficit had exploded to $2.7 billion. There was no cushion because the cushion had eroded on the way up. Archegos could not meet the calls. Its $36 billion of capital was, in effect, already gone. By Friday, March 26th, it had defaulted. The night before, the banks had met to negotiate an orderly, coordinated wind-down, to bleed the positions out slowly and limit the damage. The cooperation collapsed. The game theory is brutal and clean. The first to sell escapes near the last good price. Whoever waits eats the impact of everyone else's selling. Goldman Sachs and Morgan Stanley broke first. On March 26th, Goldman blasted out roughly $10.5 billion of block trades. Morgan Stanley, about $8 billion, nearly $19 billion in a single day. Each sale drove the underlying down, deepening every remaining dealer's deficit, forcing more selling. A self-feeding fire sale. When the dust settled, the 8 underlying companies had lost more than $100 billion in combined market value in days. The banks that moved last wore the losses. Credit Suisse, about $5.5 billion, Nomura, roughly $2.8 billion, Morgan Stanley, about $911 million, UBS, about $774 million, Mitsubishi UFJ, around $300 million. In total, more than $10 billion. Goldman and Morgan Stanley, the first movers, got out largely whole, though Morgan Stanley still ate its $900 million. The lesson was not superior risk models, it was speed. On March 29th, when the exposure went public, Credit Suisse's shares fell about 14% and Nomura's about 16%. Cooperation had been the losing move. At the center was Bill Hwang, a protege of the legendary Julian Robertson, a so-called tiger cub. This was his second act. His prior fund, Tiger Asia, had admitted wrongdoing in 2012 over trading Chinese bank stocks on inside information, and Hong Kong had barred him from its market for 4 years. Now his paper fortune, reported by Bloomberg at around $20 billion, by the Wall Street Journal as an $8 billion loss over 10 days, evaporated. Here the popular story gets it wrong. Total return swaps are legal, routine instruments. Using them was not the crime. Prosecutors charged something else, that Hwang lied to his prime brokers about how concentrated and leveraged he really was, and that his relentless swap-driven buying artificially inflated the very stocks he held. The deception was the crime. The swap was only the disguise. For Credit Suisse, Archegos was fatal in slow motion. Its independent review found a fundamental failure of management and controls, warning signals ignored, limits breached, a desk chasing short-term fees. Stacked onto the near-simultaneous Greensill collapse, it gutted the bank's credibility and helped drive the confidence spiral that ended in its emergency takeover by UBS in March 2023. The law caught up. In July 2024, a Manhattan jury convicted Bill Hwang on 10 counts, including securities fraud, wire fraud, and racketeering. In November, he was sentenced to 18 years in prison. Prosecutors had sought 21, plus a forfeiture judgment of roughly $12.35 billion, a court order, not cash he possessed. His chief financial officer, Patrick Halligan, was sentenced to 8 years. The regulators moved to close the blind spot, new rules to force the reporting of large swap positions that Archegos had hidden inside. But the mechanism outlives the paperwork. Synthetic prime brokerage still has no coordinating agent when a shared client defaults. 9 sophisticated banks each financed a maxed-out, one-way book because the law let it hide, and their own desks underpriced the concentration. It was never an exotic instrument failure. It was leverage you couldn't see, in stocks nobody could sell at once. The oldest trade in the book, wearing a modern mask.